In this video, I'm going to try to illustrate all of the important ideas that are in Tuckman's Chapter 8, which concerns the shape of the term structure and what are the key influences on the shape of the spot rate term structure. So I'll start with pure expectations, and that's where the term structure will reflect only expectations about the evolution of future spot rates, but that's going to be a naive theory. It might be convenient because we can say the term structure of spot rates might be flat at 10%, but I'm not illustrating that here. I have here a non-flat curves. All of these are nonlinear. That's because they incorporate the two influences on the shape of the term structure that are mathematically justified in Tuckman's Chapter 8. These are not easy ideas. The first one I'm going to do is the more difficult one. That's to mathematically show how convexity shows up in the shape of the term structure, and it is going to be here a force that pulls the spot rate, these longer term spot rates down. The convexity is going to show up with a higher price for the bond that we paid because it's a benefit to the buyer and a lower long-term spot rate. So convexity is going to pull this term structure down. That's why here in the middle, I have a curve that's initially going slightly up, but then is coming down. So convexity is the harder one, I think, to explain. I'll do that first, and then just briefly we'll do the risk premium. That's more natural. That's compensation for the duration risk. And so that's going to be responsible here for all of the upward sloping. The greater the risk premium relative to pure expectations, that implies an upward sloping term structure. So I think the most interesting one here is the middle, where we have a modest charge for the risk premium of 20 basis points, which is creating relative to expected future spot rates of 10%, which under pure expectations would imply a flat line. We add the risk premium. That's going to introduce upward slope into the term structure. But that upward slope that's reacting to the risk premium that is naturally charged by investors for the uncertainty, call it duration risk or volatility if you like, is going to be slowly overcome here by the downward pull of convexity. That convexity here in that relationship between price and yield, which is unequivocally a benefit to the bond buyer. After all, as rates go down, that convexity is going to accelerate the gains, and as rates go up, on the other hand, it's going to mitigate the losses. Unequivocal benefit. It's going to show up in a higher price paid and therefore a lower long-term spot rate, giving rise to this nonlinear shape of the term structure of spot rates. So I look forward to sharing both of those two forces that improve on our naive pure expectation theory. Before I add the two dynamics, I'll start with a baseline. And the baseline is pure expectation theory. It gives rise to very uninteresting spot rate term structures. That's why I have plotted here three term structures, each corresponding to a different scenario. And the scenarios concern the expectation of future spot rates. Those are here in yellow cells. I have increasing, flat, decreasing, using Tuckman's number, so these rates are very high, and the scenarios are also pretty dramatic. But you can see in our increasing, or all three scenarios, we start at an initial one-year spot rate of 10%, and then our increasing, what we have is a consensus forecast that that one-year spot rate next year, that's the future one-year spot rate, will jump to 12%, and then in the third year, the future one-year spot rate will jump again to 14%. And so under flat, we just assume that the consensus is that 10% one-year spot rate will be constant or flat. And under decreasing, it's dropping from 10 to 8 to 6. So in the yellow cells, again, we have one-year spot rates all starting at the 10%, but then either migrating up or down or staying flat depending on the consensus. And then we're plotting over here these numbers, which are the implied term structure under pure expectation. So you can see that's why I have these labels here. 2-year spot rate, 3-year spot rate. Under the increasing, the scenario of consensus increasing spot rates, our 3-year spot rate, our implied 3-year spot rate under pure expectation, you can see is just shy of 12%. Why is that? Well, because under pure expectations, it says that we could invest at 10%, and then we'd expect to roll that over at 12%, and we'd expect to roll that over again in the 3rd year at 14%. So let's just say it's $1 invested at 10, and then next year at the consensus 12, and then the 3rd year at the consensus 14%. If everything goes as we expect, we would have $1.40 at the end of the 3 years. And that is consistent with here, investing at the spot rate of almost 12% compounded over the 3 years. These are equal, and so this 12% is right here. This is a term structure that we could look at today and would be consistent with pure expectations because there's no modification, there's no adjustment in there for risk premium, for liquidity, or for convexity. That's the baseline. And the most interesting and obvious baseline, or at least interesting, most obvious baseline here is flat. Typical exam type assumption. 10% spot rate, and we assume flat expectations going forward, and then under here, under pure expectations, where we add nothing for liquidity, risk aversion, or convexity, the implied term structure, as you would expect, is flat at 10%. Okay, so now let's look at the effect of convexity, and first, the mathematical reason for why it's happening is called Jensen's inequality. And so here I've plotted the typical price yield or price versus interest rate curve in green. I have rates at the bottom. Mine is exaggerated for a long-term zero coupon bond, so I exaggerate the convexity effect. And then we just look at this in terms of, you can see here 8% and 12%, and then the middle. Because I'm going to follow Tuckman's scenario where we start at 10%, and then what we ask, what's the impact of convexity when we are going into a rate tree where that 10% is going to either could jump up to 12% or drop down to 8%. So here, I'll just identify 2 points on this plot. How about at 8% and at 12%? So if I take a look here at the 8% point here, and just for a single period, ask what is the price? Well, 1 divided by 1 plus 8%, and I'm going to get a value here. You can see 0.92593, and I'm going to continue here this convention of omitting the face value of the bond. So if you like, you could think of this, if this is a $100 face value, or let's say $1,000 face value, this bond price would be $925.93. Okay, so then I'm going to copy that down at 12%, and of course at the higher yield we expect a lower price. So here at this point, 12%, we're getting a 1-year zero coupon bond price. You can see again, it's very simple, with annual compound discounting of $892.86. Okay, so that's when we look at the interest rate tree, that's going to be a down jump, and this is going to be the up jump. And then what about where we expect in the middle at 10%? Well, there's 2 ways to look at this, and this is the Jensen's inequality. If I take the average of these two, and these are prices on the y-axis, if I take the average, right, I can do that right here, I'm going to get a price of $909.39, but that is different than taking 1 plus 1 divided by 1.1. Excel's giving me a little error. I'll get rid of that. Okay. And this is the Jensen's inequality. If I take the look here on the plot, this point is $909.39, and this point is $909.09. And mathematically, our Jensen's inequality is represented here. At the higher value, you can see here, I'm going to just say approximately, is the expectation of 1 over 1 plus the rate. Or in other words, the expectation in terms of the prices. Price at 8, price at 12. This point, being halfway horizontally, is the average or the expectation in terms of the price function. The lower value here, the 909, is really 1 divided by the expectation of really the rate, or 1 plus the rate. And you can see the 1 comes out, so these are equivalent. So subtle difference, but gives rise to a difference in the price. Which one is correct? Well, it's not that one's correct or incorrect, but rather what we'll see now is that the convexity, what it implies on the pricing, is the higher price. In effect, if you think of yourself as the buyer of the bond, you're going to pay a higher price than you would expect under this function, and that's the price effectively for the convexity is implied by this Jensen's inequality. So now let me take a look at that. And now this is really the core exhibit, again using Tuckman's number, that illustrates this convexity and ultimately the value of the convexity. And you can see here what we're showing is that the 2-year spot rate is less than 10%. And the difference between this 2-year spot rate of 9.982%, it's only a little bit less, it's 1.82 basis points, and that's the value of the convexity. Put another way, you can think of it, it's the slightly higher price you're going to pay for this bond due to the convexity. Right, so here is that binomial interest rate tree, right? Binomial because at each node we either go up or down. Today at 10%, but now we go from a certain world to an uncertain world where it could go up to 12 or down to 8. So I'm showing a 200 basis points, very dramatic jumps. And this is a 2-year bond, so that means in 1 year, the pricing is very simple. It's just going to be discounted again with, very simple here, with annual compound frequency, if you like, or with annual discounting. Of course, we could do continuous or other discounting convections, not really important. If the 1-year spot rate jumps up to 12%, then we have here a lower price, and if it drops down to 8%, we would have a higher price for the 1-year bond that matures in only 1 year, right? So that's, if for $1,000 face value, this is $925 and about 93 cents. Okay, so these nodes are pretty straightforward. And then this node here is just classic idea in that in any binomial is the expected discounted value, right? That's all I'm doing here. If I just take 50% probability of going down to this price because the rate goes up, plus 50% probability of going up to this price because the rate goes down. If I stop there, then what I have is an expected future value, but then I would discount that at here, the 10%. That's where we are today, so there's no choice to make about that rate. I'm just discounting back to time 0, if you like, and I get bond price against a face value of 1,000 would be $826.72. Okay, over here, this part's in Tuckman, this part's my own. I don't mean to confuse it, but just to illustrate the Jensen's inequality. Here we have maybe what you might expect under that sort of baseline without convexity scenario. After all, this interest rate tree you notice it is centered on 10%. So there's a sense in which we do have volatility, but we do expect here a 10% outcome. So if the yield were 10% here, the price on this bond would be $826.45. Small difference, but this price is lower than the price we actually get. What we actually get here is this price, and maybe I'll just color it. So we're emphasize here the fact that we have a match. And this illustrates the Jensen's inequality. What we're getting here is that the side of that inequality where the price is greater. Here we're getting a price of $826.72, and it corresponds to a yield of 9.918 or 9.982 rounded. My spot rate function is inferring the 2-year spot rate from this price is very straightforward, right? I literally solve for the spot rate, and I can just check it by saying, okay, if I just compound at this spot rate over 2 years, paying this price, or let me put it another way. You or me are gonna pay this price, and then we're gonna get this spot rate over the 2-year period. I end up with my face value at the end, exactly my face value, confirming that's the 2-year spot rate. It's less than 10%. The difference there is the value of the convexity. So that's the whole point about the convexity dynamic. Effectively, if you think about purchasing this bond, what's the idea? The idea is that you might expect to pay $826.45 and locking in an expectation of a 10% yield. After all, 10% in the middle here. However, the convexity effect, the value of the convexity is 1.82 basis points, such that you're actually going to pay here a slightly higher price, $826.72. It's a higher price, implying a slightly lower yield than the 10%, which of a 9.82, as effectively the value of the convexity. If you're buying the bond, that's the cost of the convexity. Why would that be? Why should the bond price be higher and the yield be slightly lower because of the convexity? Well, if you think about buying the bond, the intuition should be very straightforward. Here we are at 10%, not the best job ever for me, but rate and price. Here we are at the 10%. If you buy the bond, do you prefer convexity or not? You absolutely prefer the convexity, right? If the yield goes down, right? If I just draw a linear tangent line, that's our duration. Yield goes down. Convexity is that accelerating price. You're gaining even more than you would gain without convexity. You're accelerating on the upside. On the other hand, if the yield goes up, so that was yield down, price up. On the other hand, yield goes up. Of course, bond price goes down that you bought. You don't want that. But the convexity is also working in your favor because it's buffering or mitigating, it's decelerating your loss here. You're winning bigger due to the convexity in the upside, and you're losing less on the downside when yield go up. So convexity for you as a buyer, long position, is unequivocally a good thing. It makes sense, doesn't it, that the price for that convexity should show up as a higher price on the bond and a lower expectation of the yield. So that's the theory behind pricing the convexity in. And then I've just done there a 2-year zero coupon bond. On the left here, what we already saw, 200 basis points, pricing that bond at $826.72, value of the convexity, small, 1.82 basis points, and then just getting even more dramatic here. Also, that's the next step in the Tuckman, where the jump now is just 400 basis points instead of 200. And you can see that the same exercise, we do that discounted expected value, or I should say expected discounted value. the price of the bond is such that the value of the convexity is higher, right? So more convexity implies a lower spot rate, or put another way, we'd pay an even higher price for the bond due to the higher value of the convexity. Further, Tuckman also does a 3-year zero coupon bond. So here we have same 200 basis point jump going out this time over 3 years. So now the bond's not pricing at par in year 2, but actually just discounted. You can see here, just discounted 1 year because it'll be par in the 3rd year. And then so now under the 200 basis point scenario, that's the first one we looked at. You may recall when we had a 2-year bond for this kind of volatility, the value of that convexity was 1.82 basis points. You can see it jumps up here to a 3-year, under the 3-year zero coupon bond, to 4.85 basis points. So we can see now the value of that convexity is increasing both with the volatility assumption and with the term. If you've worked with bonds at all, I'm sure that's intuitive, right? We get more convexity if we go out to a 30-year zero coupon bond. In fact, the convexity for 30-year zero coupon bond is approximately 30 squared, or 900 squared years. Okay, and then if I just go and do the 4% scenario, you can see here that under the 400 basis point volatility into the 2-year bond, may recall that was 7.28 basis points for value of convexity. That's jumping up to almost 20 basis points for the value of the convexity into the 3-year zero coupon bond. So we can see here, of all the 4 scenarios we've looked at, we got the highest value of convexity when we combined higher volatility with a longer zero coupon bond. Okay, so that really was the more difficult dynamic of the two. That's the value of convexity that shows up in the term structure by depressing the spot rate or pulling it down. The other one that I'm not going to spend time on, just except to show you the risk premium idea. That's just the separate idea that if you were going to buy this bond, the uncertainty in comparison to the certainty of 10%, if you're risk averse, our natural assumption, you would charge a risk premium for that. So, and this is the more natural explanation of the upward sloping term structure relative to, we could have that flat consensus expectations on 10%. Under pure expectations theory, we'd have a flat term structure. But if we add a risk premium, that's going to be upward sloping. So Tuckman's scenario is that maybe we would charge a 20 basis point risk premium, and that we could model that in the tree. Here on the right is that same tree that this is actually what we do model for the actual evolution of the rates. But here we add a 20 basis point premium per annum, so 12.2, and this is 14.4, or plus 40 basis points over 2 years. 40 basis points relative to what we would have. And so this, we add the risk premium here into these nodes, and that reflects the risk aversion due to the uncertainty. You could also really think of this as the duration risk. That's the interest rate. This is the duration risk as opposed to what we looked at before. It was really the convexity risk. So now we've covered both of the key components. And so if there's a 20 basis point risk premium, then this effect goes in the other direction. As you would expect, these are higher discount rates, and those culminate here in expected discounted value of a lower bond price. In fact, the without the risk premium, right? If I just so we see what we had before without it, for the 3-year bond, we'd have $752.31, but I put in the 20 basis point risk premium, and we get a lower price, $748.22. Okay, so this lower price, you notice, implies a higher spot rate. So this is the easier one, I think, the much more intuitive one. The higher our risk premium is compensation for the duration risk. The uncertainty in the tree here implies greater discount rates, a lower price that we'd pay for the bond, and therefore a higher spot rate. And that's going in the opposite direction. The duration risk, if you think about the buyer, the duration risk is really working against us, and the bond's convexity is working for us. And so that's why these two effects combine here to explain here this theoretical shape of the term structure, where you can see that's really the whole point here. Although I've illustrated here a 0 risk premium and a 40 basis risk premium to show that the risk premium here under these assumptions has the more dramatic effect. The greater our risk premium here, the more we're pushing up the upward slope of the term structure. However, I think the 20 basis point here is in a sense the most interesting one, right? Because what we have here is some curvature, not very accentuated, but we have the risk premium pushing the term structure up, but the convexity effect pulling the term structure down. That convexity being beneficial, depressing the spot rate in the term structure, so that's why it's pulled down as we get out longer. Up for risk premium, down for convexity. And that's really, in many ways, the summary of the whole chapter, Chapter 8 Tuckman, that gives some theory around these two forces, risk premium for duration and the convexity effect, that together can explain a lot of variation in the term structure, variation from what we would have had here, very flat under pure expectation theory. So if this video is helpful, subscribe to the channel and you'll get notified of my next video.